Hi, and welcome to Strategic Equity Management's quarterly economic update. Now, for those of you that have been waiting for one, I know it's been quite some time. I think we're going on a year and a quarter since our last one. But rest assured, nothing's really changed with the economy. In fact, I've really struggled as to why should I put in the work to do this when it's pretty much saying the same thing. We've talked about that a lot in the blog. We've pretty much just kind of had a year of type of growth. But given that the Federal Reserve has put such a heavy focus on the economic data, saying that's the reason that they may or may not raise rates, I thought now would be a really good time to take a step back, look at our economic indicators, the ones that helped us call the recession before it started, but we started talking about in late 2006. We also called for the end of it in July 2009, almost to the day when it ended. So these indicators are not perfect, but when you look at them all together, they kind of give us a picture of what's going on with the economy. So here's a quick glimpse at what our economic indicators are saying. We have the table there of my favorite indicators, the ones that have truly helped us over the years, look at what's going on with the economy, and then I broke them out into some different groups. And you could see we have 4 of them growing above trend, we have 3 of them growing at about a normal trend, 2 below trend, and 1 that I would call stall speed. So being called Mr. Sunshine, let's take a look at some of those that I think are going to be issues. We know, the default is the economy is doing well. Let's look at the things that maybe aren't doing so well. That could be an indication of trouble ahead. First off, just like I said at the top of the page there, where's the wealth effect? You look at what's going on with the economy, and the Fed really thought that we would see a trickle-down impact from their quantitative easing, ultra-low interest rates, and we simply just haven't seen it. In fact, that dashed line shows the linear trend of consumer spending, and it's not a good sign. You look at the blue line there, which matches up where we're at right now as far as consumer spending goes, and you could see we're pretty much at levels that prior to the Great Recession, those were during the depths of the recession. So we've seen just a really slow pace of consumer spending growth, and it just doesn't seem to be changing. And if it doesn't change soon, we could run into some issues. The bigger concern I have, though, comes from manufacturing. Now, I know manufacturing still is only 30 to 35% of our overall economy, depending on what numbers you look at. But it is a sign of economic growth, and it kind of ties back to what we saw with consumer spending. And so if we see signs in manufacturing, we could be looking at trouble. And a couple signs of trouble there come from both supplier deliveries as well as the order backlog. Now, they kind of work together. As deliveries increase and become quicker, that means that the economy is actually getting worse as far as manufacturing goes. And then it piles up, and we start to see, as the backlog falls, that's an issue because we don't have that pent-up demand that can help things. So overall, though, what does it mean for the economy? We showed you the chart that indicated, we have more indicators growing above trend than we have growing below trend. We have a whole bunch kind of right there in the middle, and that's basically where we're still at. We're looking at maybe high 2%, possibly 3% over the next year. Now remember, when I use my economic indicators, I'm talking about the annual year-to-year growth rate. The numbers you see each quarter are an annualized rate based on just the quarter versus quarter growth rate. And I say it every time in our blog, that's not a good way to measure anything. You can't annualize something on just a quarterly basis. So we choose to use year-over-year growth rate, so we're still looking at that kind of type of growth. But the main thing we're going to be looking at is, can we actually get above trend? Because if you consider all the things that have been happening, quantitative easing, our government deficit spending, I think it's like 9 or 10 trillion and counting, the $3.5 trillion the Fed created, low interest rates, we've only had 6 of the last 24 quarters actually be above trend. And that becomes an issue. What else is going on that we can't hit above trend growth even despite that? And that's something that's really the Fed is going to have to deal with. And when it all comes down to it, what's going to happen in the economy? We're seeing manufacturing slowing. We see consumer spending not doing that well. It's really going to come down to housing. And this is probably my favorite chart as far as what's the economy doing, what's our outlook. And it ties back to how many houses are being built. And it goes along with 2 things. the level of economic activity that is surrounding a new home breaking ground and then being built and then somebody moving in is tremendous. But secondly, it's a sign of economic confidence. It's a sign that people feel, hey, things are getting better, I'm going to buy a house. Now, I believe firmly that when the Fed told everybody they may raise rates this year, we saw a big pop in housing. So if the Fed does raise rates, is that going to cause a slowdown? Or even if they delay, did we already see all the growth we could potentially see in housing, and are we going to see it pull back? Now, manufacturing and consumer spending is saying it may pull back. So we're going to be watching housing starts and building permits very, very closely over the months ahead as a potential indicator that we're going to go into a recession. But when it comes all down to it, it's all about the Fed. This chart here shows the Federal Reserve balance sheet in blue, and you can see the way it's had an impact on the stock market. The times we haven't had quantitative easing, after QE1 and QE2, we saw a quick drop in the market. This time, though, as the Fed has kind of said, we're going to take our time getting out of this, we're going to keep our balance sheet the same. Instead of seeing that quick drop, we've kind of seen this up, down, up, down, up, down, as everybody tries to decipher what they're going to do next. But what I remind people of, we're entering a new era that we have not seen since Alan Greenspan was at the Fed in 2006, and that's a Fed that is not in loosening mode, but potentially in tightening mode. And that's something the market has not had to face this entire recovery. Now, we've covered a lot today. I really hope that it's not going to be another year and a quarter before we do another one of these. I'm going to try to put forth the effort each quarter when it's all closed up, take a look and see where we're at. But in the meantime, check out our blog, semtradersblog.com, go to our website, and just look for what we're doing in the meantime. Thanks for joining us, and have a great day.